Hi Dinshaw, welcome to the Sensei Kujaku show. Thank you so much for coming on.
Thank you for inviting me to your show.
I have to start with the most obvious question, which is how many hours do you work every week?
where it starts at, my day starts actually at 7:30 and end is normally on a normal day at 7:30, 8 or so.
But in some sense it never really ends, right?
Yeah, it never really ends. When you go home, you pick up your emails, you start working on those also, so it never really.
In philosophy, there's this hypothetical question that people ask to gauge how people view their own lives professionally, personally, and whether things have worked out or not. And the question is that you go to someone who's in their 40s, 50s or older, and you ask them that, what would you rather have today? What if I gave you, say, 1 crore, 10 crores, 100 crores, 1,000 crores, depending on who you are? Right. Would you rather have that, or would you rather go back to the age of 18 and start all over, but with everything that you know today?
Well, I would have loved that.
So the interesting thing though is now that Helios has this mutual fund license, it's an incredible situation where you have someone who's been there, done that, and magically is in a sense going back to 18 and starting from like a completely blank slate, right? Not burdened with anything that happened in the past, and you can benefit from everything that you've learned over the years. So I want to in some sense just get a sense of how you feel today, and is it excitement, nervousness? What is the feeling in Helios right now?
So okay, let me tell you that the first question you asked, that if I was to go back, probably with this kind of knowledge, if I had gone back to 18, and I would have been on the same line, I want to change that line. But yeah, I mean, I would have been a master at this game. But anyway, as you rightly stated, that CEO is something new for me, right? I've always been in equities. In fact, I started my career way back in 90 in equities alone. And since then, it's only been equities. And now, looking at running an organization, now you started respecting the MDs that you meet in corporates, and you know what their pressure they go through. So that's really being appreciated now. But I think it's like I won't say a learning curve, but the fact is that you're trying to run an organization now and trying to make it much more profitable. I mean, as a mutual fund is obviously a huge burden because you're managing other people's money, so you have to have fiduciary duties in place and stuff like that. So that responsibilities are something that you've got to be careful about, as well as you make sure that the organization is going on the right path and profitability and so on and so forth. So it's I would say a learning curve for me. From after 57 years, I'm again relearning my stuff.
Yeah, and also now when you meet managements of companies, you have to learn management speak where you can answer a question without really answering it also. I think that's a crucial skill for any CEO. But so I want to talk about the mutual fund, and obviously given the fact that money's coming in right now and there's all the restrictions, and so I don't want to talk about any specific stock or anything like that. But I just want to get a sense of how you think about constructing a portfolio today. And of course, it's not that you're constructing just for tomorrow, right? It's a longer term thing. But so how are you thinking about where we are today in terms of building a portfolio, given what I said, that you're not burdened by anything you've already done?
Right. So, okay, let me now take you back to our philosophy a bit. I'll just touch upon it a bit, and then you'll realize that where I'm coming from. So we have a very different way of looking at our investments. In fact, I remember when I joined Alliance in 2000, Samir is the architect of this philosophy, and he told me that time we were still formulating. I mean, he knew what he was trying to say, but ultimate structure came in Helios. So he said that, look, you don't get confused that I want you here to identify good ideas. First, I want you to be clear about stocks you don't want to buy, groups you don't want to buy, valuations you hate, industries you don't like. Be very clear about that. And then whatever is left, then let's work on those, right? So now we realize it's called elimination investing. In fact, we trademarked that term, elimination investing as such. And actually, it is a philosophy of life itself, right? So when I say that a person steals, he's bad. But if I tell you he doesn't steal, you will not straight away conclude that he's a good guy. Just because he doesn't steal, maybe murders people for right? So to light out, yeah. But the fact is that you rejected that person because he was stealing, and that came with a conviction. So rejection always comes with convictions. Till that thing changes, you don't get it back in your portfolio. So that's how we look at our investments. So we have this 8 parameters, which over time we've further modified as such. But these are broad 8 parameters. So basically we start with the 3 factors are related to industry, 3 are related to management, I mean the broader factors, and the next 2 are basically on medium-term triggers, and the last one is valuation. Can you imagine we tell our analysts not to look at valuations till the time you clear the first 7? Because we don't want an analyst to get confused that you come and tell us that valuations are cheap, but the management is bad, right? So we always conclude that the management valuations are cheap because the management is bad. Yeah. So that's why we tell them that valuations is the last stage that you look at. So once you come up with the number of, so basically when he started off in 2005, we put the NSE 500 through this sieve of selection criteria of 8 factors. And at the end of the 8th factor, we were left with some 90 or 100 stocks from the 500 that we put through. Today, that universe is around 170, 180 odd stocks. But the fact is that that universe tells you that nothing obvious bad is there in that, right? Some bad may come up at a later stage, but as of this time, there's nothing obvious which is bad in these. We don't call them good stocks because we know there's nothing good in life, right? It's always not bad. So that's what we say, okay? So these are not bad set of stocks. And that's where the manager starts looking at. Now the criteria is such also, the selection criteria, that it throws up trends, right? The manager doesn't have to use his mind whether now value is going to take up or growth is going to kick in or say pharma is going to kick in or something. They itself sieve out that way, right? The industry trends come out. The trends for momentum or growth or value, they keep coming out, right? So now he has this set of 100 odd stocks from which he has to make his portfolio. So that's how we construct our portfolio. If you ask me today how that trend is working out for us, I think basically 4 major industries is what has come up in our trends. One is obviously consumption, because if you're talking about the economy growing the way it is supposed to grow, I mean, we're supposed to be the 3rd largest by 28, by 28, right? Economy in the world. Then consumption has to kick in. So that's obvious that our selection criteria has thrown up a lot of consumption stocks. Financials are a core part of the portfolio. Again, financials are not only needed for to fund the consumption, but also needed to fund the capex that is needed when the consumption starts playing on your capacity utilizations. So that's the second big chunk which has come out. The third big chunk which comes out is related to defense, and that also is not because of the indigenization which is happening in India, because there's quite a few cyclical stocks in the country where in the defense space, right? Why I call them cyclical is because if you place one big order, the company doesn't have capacities to execute it for the next 4 years, right? So it's stuck for the next 4 years. So those kind of companies we are avoiding, but we're looking at like electronic plays and outsourcing plays, because I think defense is going to be a big outsourcing play for India at some point in time. So that's going to be one. And obviously the fourth obvious one is the China plus one play. So that's going to kick in, and some smaller portions will kick in on the infra side, on the infrastructure build-up side and stuff like that. So that's how the portfolio construct will be.
I want to understand the internal process at Helios. So let's imagine I'm an analyst and I come and tell you, let's say I'm a BFSI analyst, I say there's XYZ bank, I think we should buy it for these reasons, and whatever, you first reject and then select, and and this is my valuation, it's at 100, I think it's worth 200 and so on. From that stage, how do you and everybody else involved with Helios, how do you decide whether or not to actually put your money into the stock?
So okay, so I'm assuming that you're our own analyst.
Right? Yeah, of course.
So when you come to us and you tell us that, okay, I've come up with this stock, I again am assuming that you cleared the 8 factors of rejection, right? So once that happens, there's a committee which sits, which consists of all the top guys. And obviously, if the manager feels that he can't wait for the committee meets practically every week. There's no hard and fast rule. You can just call for a committee meeting, which is an internal committee. So if the manager still believes that he doesn't have time, then he may take a small exposure to that stock before calling the committee. By the way, even before he does that, the stock has to be covered by the analyst in a proper format. There's a format in which he has to present to the manager in the first place. And then the manager may call for a meet, or he may just take a view that, okay, I'll buy it now and probably I'll wait for the next meet to call them in. But that, obviously the position that he'll take will be a very regular kind of position. It won't be an overweight position as such, and depending on the market cap, obviously, that's how it will work. And then the committee sits. We really thrash it out. I mean, the committee consists of people who have got 30-year plus experience in the industry. So you can imagine the kind of discussions that happen during that time. Yeah. And one more thing I want to tell you, that even before the analyst comes to the manager, the analyst will go through our head of research, who has to vet the idea and tell him that, okay, this is fine, you can go and pitch now. And our head of research is, again, 30 years of experience in equity research. So you can imagine if something comes from him, you can be rest assured that he's done his homework pretty well. So, and obviously the positioning is also such that if it's, say, beyond a large cap, right? If it's not a large cap, then probably it starts at 1.5 odd percent or 2 odd percent kind of position, and then slowly, gradually builds up as and when the manager gets comfort in the fundamentals and the workings of the firm of that particular company. So the position gets built up, and obviously price appreciation happens. So be it.
And how do you deal with differing opinions at the investment committee level? Now, it's on, like, you may argue on whether you should buy the stock, you may argue on valuation, or all sorts of things. So how is it, does it come down to a vote, or is it a question of convincing others? How does that work?
No, it's more or less consensus. There's nothing like a vote in this. Everybody has to be on board for this. So it has to be a consensus call, but mostly the rejection happens not because, as I said, that everything looks fine, right? It's mostly the call on whether this particular trend or theme that you're coming up with, or something, that some stock from a particular industry, is that industry looking good or no? Right? I think ultimately that comes down to that, rather than on valuation, because you're already clear that you're taking it because of this value, and that's why you're there discussing it. So I think the major discussion is on the industry and whether it's got a long runway for growth or no, because we believe in at least an industry to have these tailwinds, which not only carries the stock along the way in terms of growth in earnings, but also re-rate. We want the stock to re-rate along the way, because that's where the real multiplication of return comes from, right? Unless the re-rating doesn't happen, then you just keep growing along with the earnings. But once the re-rating happens, that's when you see a step-up jump in your... So that's what we try to analyze and take a call on.
In your experience, what do you think distinguishes the good analysts from the great analysts?
There's nothing like good and great. By the way, let me tell you, we always say that when we come up with this set of stocks, we will not tear our hair apart to understand that, okay, within this industry, I've got 4 stocks, which is the best one? No. We will go with whatever is there on with us on the valuation front and all. But I think the great, not the better analyst, let me put it that way. There's nothing like great or good. But I would say what sets apart an analyst from the regular crowd is to understand whether there is a long-term story playing out or not in this. You may get carried away, like every other analyst can make a worksheet, right? But the fact is, how do you interpret that worksheet? How do you interpret the balance sheet? That is, I think, more important. So we, in fact, insist with our analysts that first you don't look at the P&L. You look at the balance sheet. You take a call on the balance sheet. You see whether how clean the balance sheet is. And if you can derive, if you can make sense of the balance sheet, your P&L numbers will just flow from there. So you have to connect the numbers. The numbers have to speak to you. Literally, they speak to you if you go through enough. So that's why I hate these computers. When you see the balance sheet in a digital format, you can't shuffle pages. So that's what the problem. So our analysts are told to take printouts and look at it that way. So that's how it works for us. So I think that's what sets a good, a better analyst apart from the rest of the crowd.
So you said you joined Helios in 2000, but I want to start with 2005. So I want to start with the very start of your career.
Okay.
What was your first job after college?
Okay, so I did my post-graduation from IRMA, Institute of Rural Management, Anand, IRMA it's called. And I joined this place called NDDB, National Dairy Development Board, right? There, it was managed by Dr. Korean. So I used to work one level under him. I was a total rookie. But that is where I really learned how to read balance sheets and make my worksheets properly, Excel and all that. I learned there, not Excel. That time it was Lotus 123.
And this is which year? Sorry?
1990.
1990,
yeah. And there used to be this mainframe, which was like a freezing room. So you had to walk in with a blazer and a sweater and stuff like that, a muffler around your ears so you don't catch a cold. And you should work on your not desktop, not even a desktop, it was a mainframe, right? So you're working there. So that's where I learned. And actually what I used to do there also was something called as make techno-economic feasibility studies for Operation Flood. So we used to get money from the World Bank to fund all these dairies in various parts of the country. That's where Operation Flood came from, right? So I used to make these studies and feasibility studies for each and every dairy and pitch it to the World Bank that this is how you need to make those reports which were sent to the World Bank. So that's where I cut my teeth on research. And then the next job that I did was my immediate boss told me that you're very good at analytics. Why don't you go to the equity markets? I didn't even have a clue about equity markets at that point in time. So anyway, I said, okay, let me see how it works. And I applied for various jobs in Bombay because that was the heart of finance, right? So, and then I got a interview offer from a magazine which was one of the top of its kind, which is Capital Market, which was an investment magazine, right? There were only two at that point, the Large Street and Capital Market. These are the two major ones. And my boss used to be one Mr. Anand Raman. He was a South Indian and a very astute guy. He was very smart, very intelligent. And he was the one who actually told me of how to go about looking at annual reports, of published annual reports and stuff like that. So worked there for 4 years. I was the assistant editor when I quit that place. Joined as an executive and went up to the assistant editor space. Then I started an equity research firm. Me and three of our colleagues, we three left, and we started a boutique equity research house. In fact, my head of research, whom you see today, Abhay Modi, he was my analyst there for banking and capital goods. So he's been with me from 94. And that's where actually I met Samir, by the way, in 94. Because he was the largest fund manager in the country and we used to service him on a regular basis with our research reports and stuff like that, yeah. So that was for 4 odd years, 98. Somewhere in the end I quit. And I joined this mutual fund buy side. I went to buy side from the sell side, as they call it, which is Sun FNC Mutual Fund. I was there only for a year before Samir picked me up in Alliance. He said, you come over here and you work for me. So I joined him in end of 99. 99. I don't think you were born then, were you?
No, I'm 91 born. So,
okay. Yeah. So in 99 I joined Samir, and then we both quit together in 2003. We wanted to start a mutual fund, didn't work out that time. Can you imagine? 20 saal baad the mutual fund came. So we both quit in August of 2003, right. And somehow things didn't work out. Yeah. So Samir went off to Singapore. He was actually already in Singapore in 98. So he went back and I joined SSKI, Sher Khan at that time. Actually, SSKI just started Sher Khan. And I set up the PMS division there. And within a year, Samir started Helios and he said, come and join me. So I joined him. That's it. And since then, we've been together. So that's, in a very long, brief manner, my life story.
So Dinshaw, do you by any chance remember the first stock you ever bought?
That's a nice one. No, actually I don't. I remember all the fraud stocks which I bought. So those were my journalistic days. No, I don't.
Okay.
I won't even tell you if I do.
No, it's always one of those, people tend to remember it just because, and it's, I mean, generally speaking, it's some very small quantities. It's more sentimental more than anything else. So, so I
no, that stock went bankrupt, so that's why I'm not sharing it.
Fair enough.
But that was way back in 90s when it was like a crazy market. So.
Oh, okay. So it's a whole other world. Yeah. So Dinshaw actually,
I made money though. After that it went bankrupt. So Harshad Mehta, I mean, come on. So you can imagine.
So I want to actually just come back to the fund that you guys, the mutual fund. And so it's interesting that the way it's structured, if I'm not mistaken, up to like 35% of it can be in international stocks. Is that correct?
Yes.
So is it that's going to be a somewhat tactical play in the sense that only when maybe valuations and things like that are in your favor, or is the goal that by and large there will be international exposure most of the time?
So right now you can't even take that exposure. We've taken the provision of investing 35%, but RBI has a cap of how much they allow the mutual funds to invest, and I think the industry as a whole has reached that cap, and RBI has banned any further purchases outside. So I think that's going to be on hold till the time RBI comes and says, okay, I'm removing the cap or I'm easing up the cap. The next question I'm sure you'll ask me is that if they ease it up, will you be looking at investing abroad? Yes, we will be, because we have quite a few screaming valuations of India-specific plays in listed abroad, right? Like say a Accenture or a Cognizant, okay? Specifically a Cognizant. It's probably a mirror image of Infosys in terms of the number of people in India versus those offshore. And obviously the business model is similar to Infosys per se. And obviously they're also doing the same servicing which Infosys does, and onshoring, offshoring and stuff like that, yeah. The valuation is probably 20-30% lower than Infosys, right? So why should I buy Infosys in India? Why not a Cognizant in US, right? Yeah. So that is one. Probably there's another one that immediately comes to my mind is like a Make My Trip kind of a play. Again, there's a Ease My Trip. By the way, we don't like either of the businesses, but the fact is that MMYT, I mean Make My Trip as it's in US quoted as, that stock is probably a 30-40% premium discount to what a Ease My Trip is in India. So why wouldn't I look at those? So those kind of plays obviously we'll be looking at as such. Sure. Not that we're going to buy these, but I'm just telling you that this is how the valuations in US always been. Look at a Google or even an Amazon, right? I mean, there's not, if that kind of a company was listed in India, you can imagine the kind of premiums you would be paying today, right? So those are very exciting businesses to own as such. So.
Yeah. No, definitely. I think, I mean, there's so many, because I look at international markets as well, and sometimes you just, even if you look at it, for example, like you look at, say, Whirlpool India, as in the listed entity in India versus, you know, Whirlpool listed abroad, and I mean, the valuation differences is, I mean, it's crazy, but, so I want to now talk about, not, again, like I said, not about specific stocks, but just some of the things that come as part of your entire rejection plus selection process. And one of the things that people often think about when evaluating stocks is capital allocation and whether management is good at allocating capital. Now, there's a specific industry I want to talk about just to illustrate my point as to, you know, how do you judge whether someone is good or bad at this. So if you look at the paints industry, there's obviously one very large player, and, you know, everyone will keep pontificating on it, on all its virtues. And recently there's a sort of counter idea emerging that because of increased competition, things aren't going to be as easy, and, you know, life's going to get a lot harder for them. Now, the question, I mean, the point I'm driving at is that some of the players that are entering the market who historically have had nothing to do with paints, and some sort of have and some haven't. Now, a lot of those companies are also seen as, you know, excellent capital allocators. So there is a inherent conflict in the two. If you say both are good capital allocators, either one or both is making a big mistake, right? So in those sort of situations, I mean, how do you look at that? Again, I'm not saying you necessarily have to speak on this specific industry, but just to use it as an example to illustrate my point that, do you really ever know whether someone is good or bad, or is it just that you're good until you make a mistake? So,
okay, one of the criteria for a rejection is disruption, okay? And even after that, I mean, after that is management. So I'll tell you both how this industry fits into both, right? So one is on the disruption bit. When a huge player with a huge size wallet enters an industry which is already, I would say that growing at single digits, right? I mean, only during COVID did they grow at high double digits. They're growing at single digits. You know there's a disruption place, right? And when you talk to the incumbent also tells you that, look, I'm going to protect my market share. And it may come at the sacrifice of my margins. So it's obvious the leader itself is aware that his brand is vulnerable to that extent, right? That he can't just hold his price and say, okay, I'm a leader, I command the market out here and you pay a premium for my paint, right? Not going to happen. So that's disruption which is kicking in. So it's avoidable. In fact, the same thing happened when probably a Reliance entered the telecom space, right? You saw the kind of bloodshed which was going on as such. And here there's not only one player, there's two players who've entered. One has been there for a while, I'm a big player. The second big one is a huge one which is coming in, and they're already to an extent in that industry through the cement venture as such. So that way, so it's gonna be a tough call out there. So this is what you look out for, right? Even in say in the space, auto space, for that matter, EVs are gonna be a big challenger to the ICE, right? And it's a matter of time. I mean, today we are enjoying the fruits of COVID because there was a pent-up demand which kicked in, commodity prices came off, and that's why the margins are moving up. But the existing guys have to pull up their socks and become EV compliant at some point in time, or at least give some competition to the EV players. And EV, frankly, is a different animal altogether as compared to ICE. There's nothing like a manufacturing process and all that there. It's just an iPad on 4 wheels, right? So your servicing levels have to be, there's nothing like you got to service the car on a regular basis, nothing like that. It's just a upgrade of your program or something, right? So it's going to be a different ball game for these guys to learn. So it's going to be a major disruption. So that's what we look at, and we say, okay, fine, I can't live with this, right? So it's better I avoid this space and then look at something more. Anyway, in India, by the way, if you look at the index, the broader index, 1/3 of the stocks, 1/3, by the way, do phenomenally well as compared to the index. 1/3 of them. So you're talking about, if I'm talking about the S&P 500, you're talking about 150 stocks doing phenomenally better than the index. In some years, I mean, in around some years, bulk of the years, top 200 do better than the index. So you can imagine that you got this space of 150 to 200 odd stocks in which you can delve, and you can always ignore all these other guys who are more of a pain in the neck for going forward than trying to wreck your brains on them. So that way.
One of the spaces that, I mean, it's, in terms of the market, the largest weight, which is financials. And if within financials, if you think just of banks or more generally lending. So, I mean, a lot of people will tell you that today that's maybe one area where valuations are broadly speaking comfortable. Again, this is all subjective, but I mean, a lot of people say that. And most of the banks are doing, I mean, you see for example, year-on-year numbers, 20%, 30%, 40% growth in revenue, profitability, all of that. So a lot of people are of the view that it's a great time to invest in that space. Forget which individual company, but just generally. The counter argument to that is that competition is a lot more than it was, say, 10, 15 years back. Even the PSU guys have pulled up their socks, tech companies, all of that. So what I want to understand is, when you have this sort of situation where you could argue both the bull and bear case, it's so probable, right? At least in theory. How do you navigate that? How do you finally decide, look, because we all live in a probabilistic world, and at some point you have to put your money where your mouth is. Right. So how do you reconcile the two, and how do you conclusively say that no, either this will happen or that will happen?
So there's this is basically, and let me now digress a bit. Right. Let me tell you, if you look at the top 100 list of rich people in the world, they come from 3 sectors. Right? Consumption, tech, and finance. These are the 3. Okay, so finance is a given, right? And as I told you earlier also, that when the economy is going at this pace, there's no way you can ignore finance. In fact, you've seen that in the past also. If you go and see what happened to China or to US when they were in this growth phase, there was mainly these 2 sectors which kicked in a big way. Agreed, there's a lot of players in the market, but understand one thing, that the public sector banks, they still control around 2/3 of the balance sheet, right? Now, obviously, I don't think they're as geared towards this kind of a change in environment. Only one bank is, by the way, which is the largest public sector bank, which we believe has done a wonderful job in changing its own outlook and the way it deals with tech and all, right? So that is one that we are careful about. But the rest of the guys are frankly just surviving. So there's enough and more for the private sector banks to take over. Coming to the NBFC part, now the problem with them today would be the interest rates are peaking out, right? So your NIMs, which were already expanding, I mean, as net interest margins, because you were lending at a higher rate, but you were borrowing at the old rate, those are now going to move up, right? So the NIM compression is going to happen. But I think the bigger story here will not be NIMs. It will be basically the growth in assets, which till now, the credit growth was already in, I think, mid-single digits in the past. and now it's picking up to double digits as such, right? 16, 17% kind of growth in assets per se on an industry-wide basis. So you can imagine lower down, we're talking about 20, 25% kind of growth in assets. What we need to be careful about though is that this shouldn't come at the expense of quality, right? And that's where we are very careful about. So wherever a company comes and says, hey, my NIMs are like 3x that of the industry or 2x that of the industry, we know something's wrong here, right? Because he's going to be lending to the probably bottom rung of the borrowers as such. So it's better to be careful there. And obviously one thing that COVID helped us in identify was quite a few players came up with these numbers for their NPAs, right? Which were like way off the charts. So you realize that their control on asset quality was very lax. There were a few who came up with good numbers, and that's when you realize, okay, these guys are good players. In fact, that helped us identify quite a few companies at that point in time, that these guys are pretty strict about their lending process and stuff like that. So you better be careful. I mean, you better be happy with those numbers as such. So we went with those kind of plays as such. So that's what we did.
Yeah, so when the tide went out, you saw who was naked, right? So, but it's interesting, but on specifically in BFSI on this point of competitiveness. So I'll tell you, I'll give you a more specific point. There's few very large banks where people keep talking about how relative to historic valuations on, say, a price to book, it's cheaper than it was over the last, say, 10 years or so. It's a fairly commonly used justification for buying it today. So what I want to understand is, again, not talking about a specific company, but just that when you hear things like that, A, does it worry you that maybe people are being too simplistic in the analysis? But B, more, does it tell you that maybe the fact that the valuation is at a decadal low is a sign of the competition? That things are so competitive now that you can't just assume things will revert to, maybe the mean to which it will revert has changed.
Right. So actually you're right, because you saw one of the largest banks going through a merger and then coming down on the valuation scale, and it's yet to pick up. But that, I think, is mainly a function of the NIM, because they merged into a company where the NIMs were low. I mean, the parent company where the NIMs are lower, without naming the two players as such. Yeah. So that's what happened here. But what we further do is, if you see, so that's where Abhay, my head of research, kicks in, because he's actually a doctor in banking. Okay. Quite a few bank MDs take his advice on how to go about this and that and stuff like that. Yeah. Right. So coming to this, so he does this adjusted book. Okay. So what he does is he removes all the. So there are some obvious asset quality issues which are there in the balance sheet to see, right? But there are certain unobvious ones, which he digs out and he removes them. So if you look at the adjusted book values of most of these players, they may look cheap to you today, but when you adjust the book values for the supposed NPAs that are going to hit them, they're not cheap anymore, right? So I think that is where you're coming from. The growth has made everybody very complacent. When the growth rise up, that's when the real quality kicks in, right? And that's where your book values will start looking. So basically your incremental growth, which you think has come at a very cheap value, has not. It's come at a cost, because that's going to take away from your balance sheet at some point in time. So that's where I think things work out from. You need to have the right kind of perspective. And obviously, as you rightly said I rightly said that the industry is going to grow for a very long term. Right. So obviously there'll be enough and more for all the players to come in. And actually I'm talking about BFS space. I think I is still a very underpenetrated space for all insurance I'm talking about. But there's only a limited handful of players who are really functioning in the market as such. So,
not to belabor the point, but in BFSI, do you think that maybe outside of lending in BFSI, there's maybe more opportunity going ahead, just for some similar reasons, maybe less competition or under penetration or for anything like that?
So not really, because I think this is going to be an intrinsic part of the whole growth story. There's no way you can avoid the BFS sector per se if you're looking at the kind of growth that we're going to foresee in the future, right? So that's not going to happen. I think that's going to be a core part of the portfolio. And obviously the other core part would be consumption and the other players that I've talked about. So that's how it will work.
So coming on consumption specifically, the challenge again that most people, I mean, if even logically you think about it, is everybody recognizes they're good. Again, here I'm talking about your basic consumption, like your staples, and I'm not talking about like luxury cars and things like that. I'm thinking of basic, you know, what do you think of as FMCG companies that we think about? That everybody's okay, high ROE, high ROC, this, that, and then, but then the valuation is 50 times, 70 times, 120 times. So how do you think about that space?
So we don't like that sector, by the way. Let me tell you that. Our simple call is that just because you're earning more doesn't mean that you're gonna brush your teeth 4 times a day or take a bath 5 times a day, right? So that soaps and toothpaste, and you're gonna fill up your plate just because you're earning more, right? Or you're gonna waste food and all. So anyway, that's not gonna happen. So the staples part, we're not too kicked about. We agree with you that, in fact, that's what we always tell our investors, that when the price runs away from fundamentals, it's a matter of time before either the fundamentals have to catch up or the valuations have to correct, right? So in a market which is flattish, you'll see these stocks being more expensive, basically because people are running for safety than anything else. But if the market is running up, these guys are not going to remain there. They'll probably do a time correction. They won't give you much correction, and that's why people like these names, because they don't see an obvious correction in the price. They'll probably give you a time correction going forward. So that's why we don't like that space. So we rather would avoid, and we not, as I said, that there are 150 stocks which do well, right? So might as well look at the other, probably 20 of these will be from that space. So look at the 130 and play that number. So
and another theme that you mentioned, of course, is something that you guys are always looking for, which is China plus one. So in that, if you think of the 3 main industries in that, of course, the smaller ones, but like pharma, IT, and say chemicals, or specialty chemicals or chemicals, however you want to think about it. So if I take IT, and you know, you spoke about coming back to something you said earlier, which is the Accentures of the world. So there's one question I've never really been able to figure it out, which is that a lot of those international companies like Accenture, even though a lot of their operations are in India, they tend to have a lower margin profile than an Infosys or a TCS or whatever. I'm talking about like an operating margin level.
I got that.
So I don't know. I've never been able to figure it out, because I mean the obvious answer is, oh, they're sitting in France or they're sitting in the UK, and you know there's a guy sitting in Bangalore, so that's why. But so many of their employees are in Bangalore, right? So they should have a broadly similar operating margin. So again, I don't want to, you know, if I don't want to talk specifically on on a particular company, but just if you can explain why you think that is. And
so that just goes to show you how underpaid our Indian tech guys are, right? Because they try to keep that level of, so it's a global company, right? So they have a basic level of entry, okay? I don't know whether you saw that on Twitter or no, that the level of entry in Indian tech companies hasn't changed over the last 20 years, right? Which is like, you wonder, I mean, poor these IIT guys, I mean, what do they survive on? So that's what, I think that's where the margins suffer, because ultimately the major cost of any IT company is manpower, right? So I think their level of pays are slightly more higher than our Indian tech guys, and that's because they have a global standard of taking in people as such. So I think that's where the thing comes from. So that could be the only reason. However, having said that, we're not too bullish on tech. Right. We don't think that tech industry per se would do well till the time the US is undergoing issues. And I think the hope trade earlier was that there'll be cuts in interest rates, and as a result, the discretionary spends will come in tech spending. Doesn't happen, didn't happen. In fact, Jerome Powell, was very clear that higher for longer, right? So it's obvious that we're not looking at for even the next calendar year to cuts to happen. If anything, they'll happen at the end of the year. So I believe that next year will be a washout for tech again. So it's better to stay away from tech because the valuations anyway are looking far higher than what they were pre-COVID levels. See, COVID, the whole industry perspective changed, right? Because the growth rates kicked in during COVID time. But those have dried up now. But the valuations didn't dry up. Valuations remained at those levels. So I think it's better to avoid as of now.
Yeah, it's interesting because I remember like in 2017, there was also some, I mean, for different reasons, but a sort of down cycle in IT. But you could buy some of these top of the line guys at 13, 15 times. Right. But despite all this, they're still at, today at 23, 25, 30. Another industry that I think has had a similar sort of experience recently through COVID is a lot of the specialty chemical guys. What you had is in that COVID period, you had a dramatic increase in revenue, profitability, like, something that traditionally you had a, say, 15% operating margin, suddenly had a 25%, 30% operating margin. And they're sort of coming back down to earth right now. But the problem again in that is similar in the sense that the valuations haven't corrected nearly as much as they should. So again, how do you think about that space? Is it again just a question of waiting for valuations, or is there something else you're looking at?
No, so we are again not too keen on that space. We just have one stock in that space, and that also is mainly because of the domestic business, which provides a lot of support, which is into packaging as such, which is again a consumption-driven business. So we're more keen on that company than any others in the space. We've avoided that space for a while because I don't think China gave it up for any other reason but environment, right? And we don't believe that India should be taking up that slack, because ultimately it's environmental hazard that drove China away from that space. So in our firm, we were very clear on the ESG part, and we said we don't want to partake that. But we did pick up one company which is into green gases, and that's why we played through that. So we're not keen on the chemical space, and I don't believe they are justified to have those kind of valuations, because the world avoided that space for a reason, right? And I don't think we should fall in love for the same reason for that purpose. So.
Yeah. And just lastly on the last export-oriented industry, which is pharma, if you sort of broadly divide it as people who are mainly US focused versus domestic guys, if you talk about the US focused companies, I mean, they've gone through a lot over the last decade with FTA issues and so on. There's one sort of school of thought which says that, so I mean, a lot of the problems they had came through consolidation of the buyers. So therefore, the only way to really counter that is to consolidate yourself, right? So do you think that, how do you think about that space? Do you think consolidation is required, whether it's just Indian companies or global, other companies globally? Or do you think that even without consolidation, there is a path to success from here?
So I think the big turning point in the US was when they made up, said what, medicines for all, or I think insurance for all and stuff like that. Yeah. So I think that changed a lot of perspective, in the sense that the insurance companies also became very careful in what the doctors were prescribing and all, and that's where the generics picked up, right? And then came COVID, and because of COVID, they realized that quite a few, even before COVID, they realized that generics are cheap because of a reason, that there's always a quality compromise happening, right? And that's why they came down heavily on generic companies, specifically in emerging markets. And if you remember, prior to COVID, 4 years or 5 years were literally a dry run for pharma. There was nothing was moving. That's mainly because there was a cost involved to exporting, right? And then came COVID, and they realized that we had stuck. We need generic companies to come and kick in a big way, and so they let go of the quality constraints. There was, in fact, the US FDA stopped traveling out, right? Literally. So all the pharma companies came into play. There was overstocking happening, and then that went through again a space of destocking. I think that is what led to the recent run-up in prices in the US, because there was so much of destocking that happened. They had piled up because they weren't sure about the supply chains, and then when they realized that they got enough, and now the world is coming normal, they started ramming the prices down and selling them in the market. That created compression. But because of the ramming down, they ran out of inventories again, and that's where the inventory pile up again started as building up in the US. So I believe this growth in prices was momentary. We don't, in fact, our analysts don't believe that this is going to be a sustained move. So our feel is that it's better to avoid, the US generic plays and more concentrated on the domestic players who are more on the domestic market, because again, as I said, that when per capita moves up, these are the kind of spends you look at. You try to take care of yourself more, yours and family more, medical insurance kicks in. In fact, medical tourism also is expected to kick in. So if you're talking about that, then you're talking about healthcare and pharma, domestic pharma are the ones which are going to benefit, and that's why we are more keen on that space than anything else.
Yeah. And is consolidation, now not specific to pharma, just generally, is it something that you all actively look for or are actively avoid? For example, in the movie exhibition space, I mean, you had in recent times, the most obvious example of consolidation. So how do you view consolidation, and is it something that you're necessarily looking out for as a potential opportunity?
So the fact is that if it's consolidation happening, the reason more or less is that the industry is going through a crunch phase, right? So that's why, I mean, you saw what happened in the case of exhibition that you mentioned, that the OTT guys were becoming bigger, and obviously the consolidation happened much before the real movies came out, but still things did look up at that point in time. But we don't actually look at that space actively, only if there is a convenience getting built up, right? In certain cases like pharma companies, right? When a consolidation happens, not because they want to bring the products together and offer a higher buffet of products, right? So that's why that looks much better than anything else. So we look at those kind of factors than actually purely consolidation. So you have to look at that. If it's industry is a crunch, then obviously not.
Yeah. So Dinshaw, my last question, I want to ask about a sector that keeps going through ups and downs for obvious reasons, which is real estate.
Right.
How do you view that space? Is it so when you do, assuming you do look at that space, do you think of them in terms of micro markets, or do you think of it more as a macro play, or how do you go about thinking?
So it doesn't work in India. In fact, you saw that, right? I mean, most of the big guys, they wanted to be all India plays, right? Didn't work out. They realized that their core is the expertise in the micro markets, so better stick to those. You can go to a couple of cities, but not beyond that. You can't spread yourself thin across. And that's what happened in most of the big names, right? And they finally went back to their own home markets. I think that's what you got to look at. And one more thing that we've been very specific about is that it can't be a pure residential or pure commercial or a pure retail kind of a real estate play. It has to be a mix of all three. Only then you can play the cyclicality in the sector as such.
So that means you take a basket approach, or you're looking for one company?
We look at a company which is all of that, rather than a basket. Because if you take a basket, then one guy will be a basket case, right? So that's why we avoid that. Right. So it's going to be a company which has got a spread of all three, right? And that's what we want to play with. And more or less, even in the residential space, we look at someone who's into luxury. He's not into the affordable kind of housing space, because frankly, I mean, that's where the real margins are in the luxury space, right? And if anything, as I said, that when your wallet becomes bigger, you look at bigger houses, you look at more posh locations and stuff like that. I think that's what you want to play going forward.
And so I'm going to squeeze in one last question. Over the last 18 months or so, a lot of lessons related to hot IPOs were learned, and in some cases relearned. Do you think we're about to relearn those lessons for another time?
So I think so. I think so, because of the kind of IPOs that I see coming out again. I mean, it's like crazy, and every cycle this happens. Every cycle you see these companies and trying to get in the money at the last moment and push in their loss-making enterprises and stuff like that. No, I don't think we learned the lesson actually. So that's what we say, that what you learn from history is that you never learn. So that is the problem happening here. I think that you still got to learn that lesson per se.
Well, Dinshaw, thank you so much for taking the time. It was great talking to you.
Totally enjoyed the interview. Thank you.
Thank you.